Good evening, ladies and gents. We'll get started properly in 5 minutes. Let me do a mute myself. Let me do a quick sound check. I think we are good. Cameras on, screens on, ready to rock. Market funny day today. US market specifically started out ripping off the upside, fresh all-time highs. Nasdaq rolled over, filled the gap. Let's see where it closes. We've got quite a thick docket, I think. I don't think I know. We've got Fed tomorrow. We've got PCE. We've got non-farm. We've got some big boy earnings coming up as well. So this could change things. This could change things. Now, listen, we are at all-time highs. There is no need to be super bearish about anything, but maybe there's signs of easing back. We've got a bit of engulfing bar on the S&P 500. Look at the regular trading hour session. DAX came off obviously yesterday with the European tariff news, Euro 2. Things maybe, the next week or so is going to cement direction for everything for summer. Who knows? I mean, listen, you can't be bearish on a market that's all-time highs, but can you be prudent and aware of a pullback? Yeah, maybe you can. Maybe you can. So everything's all about Euro for you FX guys. Crude's been moving a little bit as well. We've got not much happening. Nvidia did all right, started to roll back. Tesla's rocking back. So every time I look at that, it's up 3%, down 3%, up 3%, down 3%. Elon's going to change the world. Elon's going to go bust. Elon's going to change the world. Elon's going to go bust. So it's a big mixed bag today. Let's see what happens tomorrow with Fed and all the usual stuff. I wanted to give a little extract from this book. I think this is my favorite trading book? It's got to be up there, right? You can see how dog-eared it is and well thumbed and read. Let me hold it steady for you. This is Pitbull by Marty Buzzy Schwartz. Does it reverse it on there? I don't know if you can see it. Maybe it reverses it. Apologies if it does. It's Lessons from Wall Street's Champion Day Trader, Martin Buzzy Schwartz. How can I be smart and reverse that in a mirror? I don't know. Maybe there's a setting somewhere. I'm sure you can work it out. Really cool book. Pennies on Amazon. And it's a really underrated storybook about Marty Schwartz, who basically was trading the S&P 500 electronically. So I'm not sure when he started out. I'm not sure when the actual when it's set. 80s, I want to say 80s, 90s. I don't know. I'll probably not do it justice. Anyway, electronic. So he's not trading the pit, although the pit was there. And there's a story about him going into the pit, trading in the pit, losing 100 grand and having to walk out and them all laughing at him. But I don't want to spoil it for you. But it basically talks through his journey as a trader. And I think that, for many of us who are screen-based traders, or for all of us who are screen-based traders, there's no one logging in here from an imaginary pit. We're all screen-based traders. This is kind of, a good story, because I'm going to a little extract in a moment. But there's a couple of times where he develops a strategy where he makes, significant amount of money, right? And the strategy is quite simplistic, but because he's in front of the screen, he's able to spot and identify these patterns. Now, different market, different time, different conditions, but you're in front of the screen, you're looking at the markets, you can spot similar opportunities. Now, are we fighting against algorithms? Do we have different battle to fight? Yes, we do. But ultimately, it's the same game, and this is a really good story. Okay, so let me read you a little extract from this. Let me scroll down. Story time again, ladies and gents. Here we go. I've stripped a little bit back. For 200, and basically, let me give some backstory on this rather than reading the whole thing. So he's summarizing his year of trading, the type of trades he takes, and what he's doing. So, and he's saying basically, I don't want to jeopardize my family's security. So he's trading with a reasonable sized pot, and he's never kind of swinging the bat and hoping. He's never taking big risks, and I never put myself into a position where I could be knocked out. It was a safe, unspectacular approach that didn't give me too many big victories. Okay, for 200 days a year, I'd end up with reasonably small losses netted out with similar sized gains. Lose $5,000 here, make $6,000 here, round after round, 20, 30, 40 times a day. So quite active, very active. But I'd win the other 50 trading days by clear-cut, unanimous decisions. And he's kind of referencing boxing here from earlier on. smack the bonds for $75,000, hit a stock for $100,000, nail a couple of options for $125,000, pound the S&Ps for $150,000. Over time, it made me a big winner to the tune of $5 million a year. Now, why this extract? Because obviously adjust the zeros to suit where you are now. That could be £125, could be £1,200. You get the point. But the issue here, the point of this is that that's the nature of the game, especially as a day trader. Win a bit, lose a bit, win a bit, lose a bit. But you have to be in a position, I think, where you can make kind of multiples of your R. It's okay making 2R here, losing 1R, and sort of treading water. That's okay unless you're trading massive size. It's very difficult to work out in the wash. Now he's saying, hey, I'm losing 5 grand, making 6 grand, losing 5. But ultimately now and then, when the time's right, the terrain's right, we'll talk about that in a moment, the conditions are right, he would push hard and he wouldn't risk a lot. He's not saying he would risk lows because he wanted to make sure he didn't lose his pot. He would push hard, I guess, hold a trade, right conditions, right place, right time, use his judgment, use his skill, not second guess himself. So yeah, super interesting book that. And today we'll talk a little bit about, I guess, a kind of approach that maybe he took to a certain extent. All right, let's get started, ladies and gents. Today, we're going to introduce myself in a moment if you're brand new here, but welcome. We're going to talk about the terrain target trigger framework. Little quote here from Robert Greene. Ego is the enemy of mastery. I think that as traders, we can become so focused on getting things perfect, getting things dialed in, getting the decisions absolutely excellent every time. And that's never going to be the case. It doesn't need to be the case. Last week we're talking about conviction. We're talking about, I know we're talking about conviction, we're talking about confirmation, and how, we are in our search and quest for perfection, it actually ruins the structure of the trade. The reward comes from the imperfection, the gray in the middle, the gathering as much data as we possibly can, but without waiting for the perfect, all the ducks in a row. Because by the time all the ducks are in a row, very often the trade is gone, the risk reward ratio is gone. It's just not as good. Okay, so why do we want to talk about this framework? So listen, I talk about process a lot. People talk about process a lot. Focus on the process, don't focus on the P&L, and this is all great advice. But very often I find that traders don't have process, or they'll have, it's little things here and there. It's all fragmented. I've got a checklist I do here. Sometimes I check the daily. Sometimes I check the 60-minute. Sometimes I do this. Sometimes I do that. And there's not really a clear process. And now I think one of the biggest challenges for many traders is overcomplicating this. So this kind of triple T framework, if you like, and yeah, it might sound gimmicky. You might be like, oh, what's this? Is this some sort of system? You're selling me a system? No, far from it. The idea here is to kind of simplify and really make it easy for you to follow a process each time you take a trade without going through a multi-part checklist. Now, if you're the person who does that, great. You go through a checklist, you do this, do that, fine. You're going to be dialed in. But if you're the sort of trader who sometimes adheres to a checklist, sometimes checks this, sometimes checks that, but doesn't really follow the same process, this is a different way of looking at it. It's a simple way of doing things where you can just look at these three T's and you can just say, right, this is what I need for my trade to set up. What are they, and how do they fit into the current conditions today that I'm trading, and how they fit into the type of trader I am? So terrain, target, trigger. And why we're doing this is we want clarity in our decision making, because if we're not in the right terrain, and obviously I'll explain all of these in a moment, if we're not in the right terrain, we're not at the right trigger, we don't want to be taking the trade. And this is similar to the kind of the filter trigger process we've talked about before, but with one kind of extra piece, if you like, and making it a little bit more memorable. Anything possibly I can do to help you think more about the process and less about the P&L. So focused on the P&L, it's a very, very difficult game to play. So clarity removes kind of a lot of guesswork. And by the way, I don't mean that in it removes all the guesswork and this is a very simple A to B trade. All you got to do is sit here, and when the buzzer buzzes, you press the button and you sit back and you sip your martini and make trades. No, I mean that you can make the decision, and I was talking to a trader earlier, you're making the best possible decision with the information you have at the time, looking through the correct lens. So it builds your confidence, forces clarity, adapts to your style, and adapts to conditions. I didn't mention this, but it really adapts to conditions, because regardless of whether you're in a kind of bull market that's opening up at all-time highs, or you're in a grinding lower market or a volatile tariff headline induced market or a bear market or whatever it might be, you can adjust this. So this will serve you. And like everything, guys, I want you to take this and tweak it, adjust it, chop stuff off. Don't like this, do like that, make it your own. But anything I can do to kind of help you think about, hey, if I just stick to the same process each time I take a trade, each market I'm in, each trade I'm taking, whether it's a short-term A to B scalp, whether it's a trade to hold, whether it's a trade I'm going to add to, whether it's a longer-term position trade, it's like, hey, this is the terrain, this is the target, this is the trigger. I need these three to make the trade work, and we'll obviously explain all in a moment. But having that framework, and again, you'll adjust it how you like, means that your process is the same as the same as the same. So you start to build that intuitive nature, you start to build that judgment, you start to leverage on your experience much, much more than you would do if you're kind of a bit scrappy with your process, through this stuff. So where you want to get to is this, is that most traders say, is this a trade? Is this a trade? Is this a trade? I'm not sure. Should I take it? Second guessing it, and obviously all the psychological impacts that come with that, the FOMO into trade, revenge trading, uncertainty, hesitation, all the stuff that we've covered, and we'll no doubt dig into more depth at some point in the future as well. We want to flip that on its head to this is the trade. And what I mean by this is not the certainty of I know this trade is going to be profitable, because no trader knows that. There is no such thing out there. But this is the trade that fits the parameters that I have for my trading process, for my playbook. It's the right environment. I see the target. I've got my trigger. And we want to get in a position where you are comfortable taking the risk. You're comfortable taking the trade because you've done all you possibly can without going crazy to make the correct decision. You're like, hey, these things are boxes are ticked. That is what I need to do. I'm going to take the trade, as opposed to second guessing, worrying about it. Is it this? Is it that? Going to come back and stop me out? We want to get away from all that, whatever the nemesis is for you, whether it is a hesitation, whether it is revenge trading, whether it is all those things that we know and love come to get us from time to time as traders. We kind of want to say, fine, that's going to be there, but I want to think differently about the way I trade. And again, I always say this, if we don't want to think like everyone else does, we want to try to, leverage on your experience, leverage on your intuition, leverage on all the stuff the journey you've been on so far, and not think like the mob, not get sucked into thinking like the crowd, not be staring at P&L, and not be thinking I should do this, I should do that. Okay, before we get going, of course, I want to remind you, ladies and gents, that trading CFDs, spread bets, any instrument where you're trading on margin, you've got a really risk of losing money, right? Double-edged sword. Things go very, very well if you're in the right trade at the right time, leveraged up, and things can get nasty very, very quickly. So please, I know that many of you know this already, and I may sound like a broken record, but it's important, because if I catch just a couple of traders who don't really understand the risks, and I feel that's good, because listen, we're trading a game that is risky, and we try to mitigate the risk as much as possible using risk management techniques like stop loss, position sizing, understanding gap risk, understanding slippage, understanding all the things that kind of amplify the risk. But ultimately, we're playing this game to try to minimize the risk and maximize the rewards. That doesn't always work that way, but that's ultimately what we're trying to do. And trading on leverage magnifies that, amplifies that. So please, if you are new to trading, do understand the product and instrument you're trading. Trade on a demo. They're free. They cost nothing. Get used to how stuff moves. Get used to position sizing. Get used to all that stuff before you even decide to put your money at risk. And if you are going to trade with real money, then just be sure you know what you're doing. And I'm sure you do, but I have to say this. And also a quick reminder as well, I don't stand here and say I know everything, do as I do. I am the absolute font of all knowledge. Absolutely not. I'm here, with a decent couple of decades of experience in the markets. I've got experience with other great traders. I've got experience with developing traders. I've got experience with traders who have struggled. And so I take all of that experience, if you like, try to mold it together and present it to you in something that I think is going to help you move forward in your trading, wherever you may be at the moment, just to take things up a gear to the next level, the next station in your trading, whether you are kind of just coming off that beginner status, whether you've been spinning your wheels for a while and need an unlock, or whether you're doing okay and want to kick things up a gear, wherever it is. I know that not everything you will agree with that I say, and that's okay. And I hope that's the case, because that means you're thinking for yourself. But my hope is that you take away one or two nuggets with each of these kind of sessions that we do and you implement it into your trading and your style, so you develop something that's robust and is a skill for life. You're not like, oh, I'm going to do exactly that. You're like, hey, that makes sense. That doesn't. Let me take that. And so you build, it's like a recipe where you bake your own cake that suits you, your style, your personality, the time you've got, the funds you've got available, the resources you've got available, all that type of stuff. So I'm going to share with you key ideas and thoughts. As always, please do your own research. We're not talking specifically about trade setups and stuff today, but always just make sure you go down your own little journey, do your analysis, research, homework, etc. And like I say, even though I've got a couple of decades plus of experience, I'm here just to share with you some thoughts and ideas that maybe you can take and run with yourself. Okay, so that being said, let's get right back into the meat of, oh, and it broke my hand there, cracking on the desk out of joy, excitement about talking about this. But you know what, it is quite exciting, because if you can unlock this process and thinking, and often if you've been on webinars for a while, first of all, thank you for coming. Appreciate you coming on live. Makes a lot of difference knowing I've got people actually listening and talking to a camera. I don't know, that's some great Q&A at the end. We talk for about 45 minutes, by the way, if you're new here, and we do about 15 minutes of Q&A. I'll always stay and answer every question. If you have to go, I understand, but I'll always make sure I can answer every question if I can, or direct you elsewhere. So today, while I think this is good, is because it applies whether you're a day trader, swing trader, currency trader, you're trading crude oil, you're trading soybean crush spreads, maybe not, well, it probably does actually, whatever you're trading, right? And the thing is that if you can adapt this framework, then I think it's going to help. Okay, so let's get to it, Mark. Terrain. What is terrain? So think about, let me go on, I'll go back here. Let me think about this analogy. So I've mentioned this to another trader before, actually. I thought, oh, you know what, that's a great analogy. I came up with it and thought, yeah, you can be in the most super expensive Instagrammable Lambo. You can have an Aventador. You can have what's the latest one they've got? Revolton, is it? I don't even know, man. That's my Lamborghini knowledge. Revoluton. Someone can correct me on this. Anyway, the latest Lambo, right? It's not the Aventador, is it? It's old hat now. It could be one of those latest Lambos. And if you're in a plowed field, you ain't going nowhere. You're going to be bottoming out, right? And a Citroen 2CV, those of you know that car? Many of you do, right? Citroen 2CV, which was made to go along a plowed field. Google it if you're kind of young and you don't know what Citroen 2CV is. Made by the French. Perfect for a plowed field. It was made for a plowed field, right? You've got a Lambo sitting there. Let's go to the Aventador, even though it's old hat. Aventador sitting there, 2CV. What's going to win? The Lambo's just going to get stuck on the first bit of plowed, furrowed field. 2CV is going to rip, right? You've gone through a flood. You've seen there's a kind of footage knocking about where you kind of get these cars trying to go through this flood. I don't know where it is in the UK actually, but you see people like gunning through, like no, and then they're there and they're like C-class Mercs conked out. There's guys going through with all sorts of vehicles, and it just it doesn't work. You need a snorkel and a 4x4. You need to be elevated. You need to have the air intake above the water level. This is so the point of this is why we're going off on a car tangent here. The point of this is that you need to understand the terrain you're in so that you can use the vehicle for the job, or leave the car in the damn garage, right? If the road's flooded outside, then probably don't warm up the R8 and drive it out, right? Probably don't take the superbike out, because you're probably not going to get anywhere and you're probably going to do yourself damage. Nice dry day, sunny, bright, by all means, fire up the beast, get it going, fire it, and so the same with trading, right? We have to understand the terrain we're in so that we can pick the right vehicle for the job. And maybe not so much talk about that today, but mostly like, do we want to trade this at all? Do we even want to risk damaging the capital, the asset, if you like, by trying to make it perform on something that's not? Then of course we can flip on its head. You take any supercar around a track, it's going to thrash a Citroen 2CV or a snorkeled 4x4, right? And so the analogy works both ways. But knowing when to deploy it is interesting. There's many, obviously, people who have binned supercars because they've tried to drive them on the wrong terrain. A boot full of throttle around a corner, rear-wheel drive car. We know what happens. Okay, terrain. So let's go back a slide. So before you trade, start to think about this. What environment am I really in? Right? What environment am I in? Okay, and that's your terrain. And it might be different questions for you depending on the type of trader you are. Like if you're a very, very short-term scalper, you're going to ask yourself different questions. Like I said before at the beginning, you're not here to dictate to you how you do this, but some ideas is, okay, what's the market structure? Are we trending? Are there higher highs, higher lows? Are we in a range? Does the higher time frame matter to you? It matters to me. I'm interested in what the daily's doing, and I bring that down into my intraday stuff. Some people, that's not their process. That's okay. But it's like, okay, what's the rhythm? What are the rotations? I'm one for measuring rotations and looking at behavior, recent behavior, around the open or on the Monday mornings, all this type of stuff. What's the narrative? Like, what's driving the market? I remember many years ago going to visit a stock trading company in the US. This must have been, 2010, I'm going to say, maybe less than that. But one thing he would teach his traders is, hey, what's the market's engine? Like, there's something that's driving the market, whether it's up or down or sideways, and that could be the narrative, right? That could be the regime, that could be the narrative. So, you want to always understand what's driving your market, because that's how the headline is going to affect the market risk as well. And the context, like, where are you? What's the market higher time frame doing? What's the lower time frame doing? What's important to you? And ultimately, think of that analogy. Are you on the racetrack or in the muddy field, right? And you need to know this, because we've talked about this before, so I'm not going to go over old ground. But if you're trying to buy breakouts in a choppy, sloppy, mixed, dirty candles, midday environment, and you're a day trader, then you're trying to drive the Lambo over the plowed field. You're going to rip off your sump. You're going to ruin your suspension. You're going to buckle alloys. You're going to rip off your exhaust, and you're going to have a massive bill. And the same with trading, right? You try and do that. Try and buy breakouts which work exceptionally well in volatile environments where people are super time sensitive, not price sensitive, and there's urgency. Breakouts are great, right? Just like a Lambo is on a track. But you try and do that in the wrong environment, then you're just going to cost you money. So think about what your terrain is. Some things to consider: higher time frame, trending, chopping, lower time frame structure. So if you're a lower time frame trader, you're a day trader, intraday trader, maybe the 1 minute's important to you, maybe the 3, maybe the 5. If we looked at today, let's just kind of bring up the NASDAQ. I won't share the screen because we'll be back and forward, but you guys have probably got a screen up. You're watching it on the other screen, if not your primary screen. What's the lower time frame structure today? Well, we haven't even pulled back to the VWAP yet, which is unusual. So you go, okay, well, we haven't pulled back to the VWAP. We've got obviously a lot of selling pressure. Buyers aren't stepping up. That's interesting. So the terrain might be, hey, do I really want to buy fresh highs here? Maybe not, because the terrain is still a bit uncertain. We're not bearish by any stretch of imagination on the higher time frames, but the lower time frames are a little bit more bearish. So the terrain, you're kind of making that calibration narrative. We've got some data coming out. We've got some economic data coming out tomorrow. We've got some economic data coming out on Friday. We've got earnings. Maybe the market isn't so bullish and buoyant normally on the dips that we get. I mean, this is still at all-time highs pretty much, but from a short-term perspective, and you tailor that to adjust your trading, you might say, hey, maybe we're in a kind of holding pattern here. So maybe I need to wait and think. The terrain is this. What are the range? What's the rotations? What's the drives? Have we had any traps or reversals? This type of stuff. And again, just like Marty Schwartz would, use his own style and strategy to trade the S&Ps, and sometimes it was super simplistic, but made him a fortune. You adjust what's important to you. Like, sometimes, I might be talking about the higher time frame. Like, I'm a hyper scalper. I trade on a 15-second chart. Then you don't care on the higher time frame. You're not interested. Maybe you are, you're interested only in waiting for one specific setup, and so you'll kind of calibrate and say, what's the perfect terrain for that? I want to find the perfect conditions to go, off-roading in my beat up 4x4. Okay, well, I don't want a nice bright sunny day. I want a bit of mud. I want whatever it might be. I'm making stupid stuff up on the fly, but you get the idea, right? So you need to find what the terrain is for you and the environment. And this is why we're coming to this triple T. Yeah, and I really want to emphasize this point, and I don't apologize for sounding like a broken record, but ultimately the best traders, and you know this yourself if you've had any kind of level of success for a sustained period of time, you have to find your own path. You have to find your own thing. So what are the personal clues for you? Is news important? Is a VWAP important? Do you not give a toss about the VWAP? Do you trade like Wyckoff Springs? Do you like seeing liquidity and exhaustion moves and this type of these flush environments? Is that important for you? Because that builds you your terrain, not somebody else's, because it's too easy. And listen, I don't want to go get on a soapbox here because that's not what it's about. And again, I'm not here to lecture anybody or anything, but often you see some excellent content that's showing you how they trade, and you then try to mirror that. I don't think that serves people, because very often it's so personal to you. You go, why is it not working for me? This guy's doing well, and he's showing me how to do that. It's like, but that's why it's finding what's right for you. And so understanding the terrain and how you measure the terrain and calibrate to the terrain is so important. And honestly, I think it's the most important part of this of the triple T, because you can get away with, to a certain extent, a sloppy entry, a loose target. If you're in a rampant uptrend, you're buying a dip, you're probably going to get away with it, right? A rising tide lifts all ships, and as long as you're not chasing with aggressive size and being stopped out on the slightest little retracement, then you're probably going to be all right. Same with a kind of range bound environment. If you're a mean reversion trader, you're selling fresh highs, buying fresh lows, probably going to be all right unless the environment changes. Your target might be off, your trigger might be off. So terrain is super important. And if you just take anything from today, just really noting down yourself, okay, what are the things that I want to look at to calibrate to the conditions? What is a terrain for me? What does a good terrain look like for me? Okay, let's move on to target. So I think this is overlooked. And again, I think maybe this is a personal thing, and I'm happy to just, be in the minority here, and that's fine. It's worked okay for me so far, but I'm happy to just, suggest this, and you can kind of go with it or not. So I think that a lot of traders don't have a target, and that's okay if it's working for you. And by the way, if stuff's working for you, don't change a thing. Just do more of what's working. Throttle down. It's working. As long as you're not a landmine trader and you've got this hidden risk you're not really accepting, if things are working for you, don't make any change whatsoever. Just do more of what's working while the conditions are what they are. If it's not working for you, fine, maybe you need to do some adjustments. Okay, so I digress. I think the target is one of the most valuable pieces of information as a trader, because it gives you conviction. And I think that is the thing that's lacking for so many traders. And I don't mean blind conviction like this is absolutely going to work, but conviction gives you so much more calmness and confidence about the trade. If you have a good idea, and that may be based on experience, maybe you do a bit of back testing, some stats, whatever it might be, that price is going to tag that VWAP, the price is going to hit that prior day's high, the price is going to retrace $50, whatever it might be. If, however you've come up with that target, if you think it's very likely, then you're able to sit through times when you've got a big unrealized P&L, it comes back, it sits there, it just helps you trade. Now, target may not be what you think it is. We'll go through some in a moment, but I think that it's super important. Now, some traders go, I don't know where the market's going to go, I just want to ride it. Fine, but I still think you can have a target. There doesn't have to be a price target. I'll explain more in a moment. But I think having something to aim for means that you change your anchor. You're looking at price. Everyone anchors it to their entry. So if you went longer 15,000, what's trading 15,000? I don't know. Let's say you went longer 15,000, whatever it might be. You're there, you're watching price go 15,000, 10, 20. You're looking at price relative to your entry. Now, if you change things and you have a target, and maybe you're looking at it with reference to your stop as well, right? Now, if you have a target, whether that's, we'll talk about some of the different ways of doing that. Now your reference point doesn't necessarily become, hey, my entry. You're looking at your entry, you're looking at your target, you're looking at prices behaving, right? So you start to see, hey, what's the reward of the trade? Is it worth me even taking it? Because you might see a great terrain, perfect, flat, beautiful tarmac, warm, lovely. You've got race tires on, you've got slicks on, brakes are warmed up. Yeah, man, this has got a super lap, right? And you might see, yeah, got a great trigger. We'll talk about triggers in a moment. But ultimately, if you don't have a target, you don't know if the trade's even worth taking. You're like, well, I can make 1 hour on this, a half an hour. Really, if I want more, I'm asking for the market to change regime completely and break out from, maybe a mean reversion market to a trending market or a momentum ignition market. And that's a completely different ask, right? So gives you the reward. What's the expected movement to get there? Having a target, I think, helps you think about, hey, you know what? We're probably going to drive. We're probably going to backfill. Maybe we'll stop a few people out. Maybe we'll congest a little bit. We're not going to go dun, 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 A to B. Maybe you do, but it helps you kind of mirror and think in your mind about how price goes from this level to this level based on your experience. Because you and I both know that price very rarely just goes up to your target straight away. Okay, and you can kind of then visualize in your brain, right, hang on a second, it's not going to be an easy ride, this. I'm trying to kind of look for a break of prior highs. We're currently trading just around the VWAP. There's a lot of time that's got to go by. There's a lot of action, a lot of volume has got to flow before I kind of get the actual ultimate target that I want. Okay, fine. I'm happy because I believe in the target. I have the conviction there. And it kind of easy to say then, what does success in the trade look like? So when it's at your target, you go, it doesn't necessarily mean you close the trade, but now you can make a decision, a commercial decision, and say, well, am I going to peel some off? I'm going to pay myself for being right and cash flow the trade. I'm going to kind of hold it and drag the stop up. What am I going to do? But you have a first point of success where you go, right, the trade has done this. Okay, I feel like it's a success now. It's hit this target, this time thing. Okay, now what do I do with the trade? Do I take the whole trade off? Yeah, because that was the whole plan all along. Okay, so examples of targets. Now the common, obviously, you know, standard ones, if you like, will be like a key level, right? Prior high, prior low, gap fill, resistance level from a multi-time frame support, multi-time frame, higher time frame, sorry, resistance, higher time frame support. If you kind of trade, you know, some different, what's the guy's name? I've got the guy's name now. The guy does liquidity stuff. ICT. If you trade that type of stuff, it's fine by me. Then you maybe there's some specific way that you look for a liquidity zone or whatever else he calls the things. Range expansion, i.e., hey, we normally do a $200 range on the NQ. Okay, great. I'm going to look for kind of $200 range today, and I think I'm in the right kind of color of the candle. I think it's a green candle. I think I'm going to put a $200 range in. We've talked about this type of stuff before, but it's where I think it gets interesting. A target doesn't necessarily have to be price. This is why I think a lot of people hate targets. They go, oh, I don't like targets, don't like targets. I don't know where our price is going. Okay, it's fine. And I agree with you. Sometimes you're in a trade, like, I don't know where it's going to go. I feel like I've got a target by the tail. I'm holding on for dear life, and I'm right. I ain't closing this thing down. I'm holding this sucker because this is going, right? And in that case, your target might be a specific time of day. This market is falling through the floor. I'm sure I ain't touching, not necessarily today, I ain't touching this until we get the bell. Or I'm holding this for at least an hour because I know that we've got at least an hour worth of rotations and move back before I even want to consider taking the trade off. So you don't necessarily always have to have a price target. Time targets are really, really useful. And again, it helps you anchor your trade to the target as opposed to the entry price. Example, you take a trade of $50 long, right? And it sits there and it's doing 49.99, doing 50.01. It's sitting there for 5-10 minutes. And you're getting frustrated. You look at the unrealized P&L up a bit, down a bit, up a bit, down a bit, and you're getting more and more agitated with it. And because all you can do is look at price relative to the entry. We've all been in that situation, right? It's up and down, up and down, up and down. Like, come on, do something. Take me out of my misery or go to my target. But if you have a time-based target, you can say to yourself, you know what? I know this might take time to get going. I'm just a little bit early. And I don't expect people to immediately rampantly buy after I bought. I just expect the market to rotate back up because the terrain we're in suggests we're in a rotational type market. We're not a momentum breakout market. So I'm not expecting price to just suddenly rip up and give me my profit. I'm expecting it to sit here, stagnate, but I generally think that the quietness is going to cause a gentle lift up, and moving average is perhaps going to start to push price up. You know, that type of rotational move. And so you calibrate to the terrain, and your target might be, I need at least an hour for this. I'm going to push this until the European close. I'm going to hold this for the next 10 minutes. Whatever the trade may be. Another example might be, let's say you're a hyper scalper trading flushes. Market flushes through lows, you grab the low print, you're like, I don't know where this is going to go. I'm not expecting a full scale reversal here, but I think a 3-minute hold is perfect. So again, we're talking super active, but it's a target based on time as opposed to price. And I feel like that's a really big unlock if you can think about that, you know, in terms of, you know, what you're trading, how your trading is, and how you kind of frame the trade and the framework you have for your trade. So we talk about terrain, target. Example would have been yesterday. Full disclosure, I didn't trade the DAX to the short side yesterday. Would have been nice to have been short on that at the open and ride the whole thing down, but no, not for me. If you were trading on the short side, example may well be, hey, my target is at the end of the day. I feel like I've got something that's different. I want to hold it to the end of the day. My target might be the prior day's low or the weekly low. I can't remember what it was, at that 24,066. You get the idea. You can come up with a price target based on how you want to trade, the way you trade, your approach, your approach to risk, your acceptance of risk. Again, back to the initial slide, it's about you. It's about doing things that suit you, not what a textbook says, not what kind of some other trader says that works for him. It's like you do what you do need to do. And so you can't, I will cover the same thing again, but I think you can't access the risk reward ratio without target. Now it becomes a little bit fuzzy. I appreciate when you've got a duration, time duration, as opposed to a price target. But generally speaking, you can kind of roughly go, okay, and we talked about this before, right? We've got two levers to pull. You've got your risk reward ratio, which is how much you're making to how much risk. So risking 1 to make 2, risking 1 to make 3, 5, risking 1 to make a half, 1 to, you get the idea. And the probability of success. So again, arbitrary, don't really know, but you give yourself a 50-50 shot of making 1 to 1. You don't want that. 50-50 shot of making 10 to 1, perfect. 70% chance of making 1 to 1, take that. You get the idea. Trying to adjust those dials all the time, and without a kind of target or an idea of where price could go, it's very difficult to assess the quality of the trade. You might have high conviction, but you might go, you know what, my stop's got to be here. I don't really expect it to go much above the current day's high. You know what, it's 1 to 1. I don't give it that. And you can start to then back off the throttle and say, you know what, it doesn't stack up for me. I'd rather wait for something else, or I'd rather wait for a better pullback or a deeper trade or the next rotation, the next sequence, the next segment of the market. And also this, I mentioned this, but you know, how many times have you been in a trade, you're looking at a trade, you're glued to the unrealized P&L, even if you've got P&L off the screen, which I do recommend, you're there and the market just goes up and then it just suddenly flushes lower. You're like, I'm going to, it's reversal. Trump's tweeted something's happened. I'm going to come out of my trade because you're worried about giving back the unrealized P&L. In actual fact, you might be like, hey, this is normal. I don't expect this to go up in a straight line. We're still okay here. Do I need to adjust my stop? Maybe I need to pull it up to break even here, or maybe I need to tighten it a smidge because I don't know if this is going to hold. Okay, well, let's just see the response to that. Okay, we climb back up again. Okay, fine. There's no need to rush, no need to panic. Just a little wobble. And actual fact, what it's done is revealed that the bars are still in control, because even with the tape bomb to the downside and people sweeping bids, we've kind of pushed back up. So you can be more reflective, more calm, and you can kind of then say, okay, well, how does it look in relation to my target? And again, you'll exit on emotion. Without a target, you exit on emotion, not logic. You can exit on emotion, not logic. And the emotion generally is, I don't want to give back unrealized P&L, which is, I think, is one of the strongest emotions for traders. Up big, not really looking at anything but how much they're losing if the market comes back against them. You're not doing what Marty Schwartz does, which is hitting out the park on the trades that are right, and all you're going to do is hitting the singles and doubles, which can work. But again, you know, if you're thinking about the size needed to do that, to carve an edge out, it's tricky. All right, let's talk about a trigger. So triggers is pretty much exactly what it say it is, right? It's how to get into the trade. So this is the third part of the triple T framework. And really, you're kind of building a terrain. You've got your target, time-based, price-based, whatever suits you, whatever time frame suits you. Now you need to think about where the trigger is. Okay, and the thing is, I think that is this the least important part? Maybe it is, but you can ruin a trade by not waiting for the right trigger. And if you remember back, those of you who were on last week, we talked about the confirmation conundrum. And if you wait too long, the trade is ruined. Talk about those levers of, okay, risk reward ratio and probability of success. You know, the longer you leave a trade to get the confirmation, the worse the risk reward ratio of the trade is, assuming your target stays static and your stop stays static, which it probably should. Then you go, later you leave it, the more later you leave it, the worse the trade is. Okay, so maybe, you know, this is where you kind of put all the pieces of the puzzle together and say, hey, I need to see this happen, but this is too far. I need to see it break this level, but not go above here. I need to see it pull back. You need to kind of come up with a trigger, which is the final piece of the puzzle of like, okay, I know the terrain we're in. I've got an approximate target. And by the way, I think this is the way to work it. Like you come back from, I'm in the right environment, terrain. I've got an idea where price could go, my target, or how long duration price could move, target, and then go to the trigger. Now, a lot of traders flip it. They take the trade and go, now, oh, sugar, where's it going to go? Oh, and then actually, you know what? I'm buying this at VWAP. It's better, I think, to flip it round and go, actually, you know what? Why don't you do the target first? Okay, so what might qualify? Standard stuff here, guys. We're not kind of reinventing the wheel. Just level break. Maybe you add volume to this. I want to see price push back up. Maybe it's a hold above VWAP. Maybe it's an inside bar then an outside bar. Maybe it's a pullback to a zone. One of Peter's favorite trades. Daily chart breaks out, pulls back slowly, tags the zone. Bump is the trade. Maybe if you're a short-term trader, you get a tape flurry or tape pause. Maybe it's a time-based cue. Maybe like, hang on a second, I want to wait until the European close. Market's been grinding lower to European close. I want to buy then with ignition bar. You get the idea. I don't need to go over every little thing, but the idea is you have some form of trigger, price break, price level, indicator if you're using it, some sort of chart pattern, something to indicate, right, this is a binary yes or no. Everything else is lined up. Now I just have to decide whether I see it or I don't. And you're not really making a decision. You either do or you don't. Example today might be the euro dollar. You've had that sell off yesterday, came back down, start to double bottom. You might be like on a 15-minute chart, I want to wait until the 15-minute chart closes back above the current day low to give me that double bottom. So, we talk about double bottoms. You have the low put in, rises up, decent width in between the two, comes back, goes lower. You might say, I want to see the 15-minute chart, 15-minute bar close back above the initial morning low before I want to go long, for example, right? That might be your thing. And so you kind of have you must be clear about when you do this. Now, can you have multiple triggers? I think you can, as long as you're not overcomplicating things. Trading is not about overcomplicating it, but it's about saying, hey, I will take this if I see this or I see this, because I think that's enough for me to get the confirmation I need. I'm not waiting for price to run on and on. I'm saying I've seen the pattern. I've got my target. My target might be VWAP. If you go back to kind of, I've got a V up on there. What a shame. Your target might be VWAP. It might be the prior high, might be whatever it is. Okay, great. That means if we look at that, that might mean if I could structure that trade, if we do close, I can have a stop below the low. I can target that 1.16 level. The risk reward ratio is decent enough. I've got the conviction in it, that type of stuff. Now, I don't think this actually played out. I think it sat there and chopped around, but you get the idea, right? You have the idea of the terrain. We're in a bull market, blah, blah. This is just a pullback. It's a bit of a catalyst. Is that overdone? Okay, fine. Trigger is going to be the close above there. My target is this. You start to build the framework out, and you can do that whether you're trading kind of the micro level, macro, or higher time frames, whatever it might be. So the reason I think the trigger is important, guys, is that you're susceptible to FOMO. We all are, because you've built the trade up. You've said we're in the right conditions. Okay, good. We're in the right conditions. Yeah, I got my target. Yeah. I think price is going to go there. And if you're not careful, you can then go, I've got to get in. Got to get in now. I don't miss this. I don't miss this. I don't miss this. I've got to get in now. And you can just, hit the bid, hit the offer, and you're not thinking clearly. And it's the final piece of the puzzle that makes or breaks the trade. The line between making it and not is so fine. It's horrible to think about sometimes. And often it's just waiting. Like, I want to see a pullback first. I can't be buying this. Yes, it's an ignition candle. Yes, it's the one I sort of want, but I need to see maybe a $10 pullback on NASDAQ. Maybe that's all you need, but something to get the entry that you like. Maybe I just want to see it break and hold. I just want to see it do this, right? And the thing is, unless you have the trigger, you might be waiting for something that never comes. You might be like, oh, well, I'll see it. I'll definitely take it. And you miss it. Right? Or you enter on a FOMO, or you chase a really crap setup. So it gives you this objectivity. It allows you to wait for structure to form, whatever the structure is to you. And otherwise, you're falling into that time sensitivity trap. And I talk about this, lots, which is, I need to get in now. I don't want to miss this. We never want to be in that situation. The only time we're time sensitive, i.e. get me in or out now, is if we're using a stop loss. And a stop loss is, you get me out now. I don't care what the price is. That's fine, because we want to limit the loss. Fine, there are other ways of doing it, but if you want to just use a traditional stop loss, absolutely. But entering a trade should never be a situation of urgency. If you feel like there's a sense of urgency to a trade, just throttle back and go, they probably don't need to be taking this. If I feel the urgency, it means that other participants are, and other participants may well feel the regret of being urgent, time sensitive, not price sensitive, i.e. get me in now, as opposed to wait for price to come back to my level. And that may result in me buying the high. So just think about that. I'm going off piece for a moment. If you feel that sense of urgency, others will be too, and others may well be buying the top, and you want to be the sucker that does that. Now, the market may rip off and off, and you miss it. But the majority of the time, being calm and waiting for price to come to you, waiting for a level to break, waiting for some structure to form, will always serve you over the sense of, I see the trade, I don't want to miss it, I need to get in. Because other people will be feeling that too, and you want to be on the other side of that trade. When everyone's emotional, you want to be calm. And that applies, if you've got flush through the lows, we often see this flush through lows, market just has a little panic, pops straight back up. Why? Because everyone's like, get me out, get me out, get me out. The whole thing's going to fall through the floor. It rarely does. Sometimes it does, but it rarely does. That's why we use stops, obviously, if it's for the times it does. You go long, you want to flush, goes another leg, you want to be out. It's not a flush. It's just another leg lower. That's what stop loss does for us. Okay, so the triple T in practice, good time. Terrain, so here's an example here coming up. Strong trend, post news, target, prior week low, trigger, pull back to today's low, engulfing bar, volume spike. Very simple. We're not overcomplicating stuff here. We're saying terrain, target, trigger, terrain, target, trigger, triple T, whatever that means to you. Example would be yesterday on the euro. I'm using kind of current examples because I hate cherry picking stuff from 1902 and it's a perfect thing. You might have seen the catalyst yesterday of the tariff deal, negotiation, outcome. What's the word I'm looking for? What's the word I'm looking for here? Result of the tariff, the deal. Let's say the deal. The result of the deal, the final deal, the data, the percentage. Euro looked like it wasn't very happy with things, and so you may have gone, okay, there's my catalyst, there's my rollover, and I'm going to kind of buy a pullback under the current low. Let's say you wanted to see it mature and see if it wasn't just a trap first. And by that time, you were like, okay, DAX is off, Euro is off. Yeah, this looks good. You might say, okay, well, actually, you know what? I'm going to hold this. The terrain is that we've got a catalyst-based sell-off. And I think we've got people trapped. People are not very happy with this. I see it across the board. Okay, this is my terrain. Okay, now I want to look at my target. Well, I think we're going to take out the prior week's low. We look like we're heavy enough. And what's my trigger going to be? Well, I want to see a pullback to a low break. And again, an example here. Look, you take this, you target with the prior week's low print. So you're putting them all together. And maybe, by the way, maybe you were long and you thought, hey, the same thing, I think we're going to, and you can be wrong, of course, and you still have a stop loss, but you're still using the same terrain target. You might be like, hey, I think we're going to bounce back to VWAP and I want to see us pop back up over that level. I'll buy it here. That's my trigger point, and my stop's going to be below the low. You'll be stopped out here. So it works both ways, of course, but what it does is it helps you build a process that's repeatable. Today, those of you in the opening setups trades webinar we did a while ago, stuff's been happening left, right, and center. The open reversal failure type trade, open Nasdaq ripped, failed. Let's say you took that short and fancied it to fill the gap, i.e. the range gap, Friday's high. So you got your terrain. Yeah, I feel like we've gapped up. Last hurrah, everyone's panicking. We've rolled back over. I know this is quite a good setup. Great. What's my target? Well, I don't want to be too ambitious here, even though, as we look in time now, you could have been ambitious, but let's say at the point in time, like, hey, just to fill the gap will be fine. There's my target. What's my trigger? Or maybe I buy below the low break, or maybe I sell a break below the open, or I sell a pullback back to the open. You get the idea, right? Okay, so some final thoughts. Terrain tells you if you can trade and which vehicle to use. Now, we didn't go into this, but maybe you're using a mean reversion strategy in a trading environment. No good. You want to use the right tool for the right job, the right terrain, or if you want to trade at all. Target, and again, terrain is for you. It's for you to figure out what the terrain is. Target, why you're taking the trade, and gives you the conviction. I think that's the most important thing, is having the conviction. If you struggle to hold trades, if you struggle to size up, if you get wobbled out by the slightest little mismove against you, this is going to help loads. And thinking about time targets. If you don't want to put a price target on it, that's fine, but a time target. and a trigger tells you when to actually execute, click the button, get into the deal. And of course, I didn't mention all this, but stop losses are super important. We have to manage risk, and that goes without saying. And this could be a framework that you can use. You can make your own. It's simple, not make it complicated, and it brings all the elements of a good trade together. That's why it's so good, because it brings everything in, and you go, hang on a second, that makes so much sense to me, and you can do it again and again and again and again. Market's selling off while I'm talking, as it always seems to do on a Tuesday. If you guys have got any questions, then let me know. Thank you for listening for now. Got a few questions come in. By the way, if you want to check out Traders Mastermind, loads of free stuff on there. We've got loads of the recordings, the webinars, got a podcast on there, got a discipline tracker on there. There's all sorts of stuff, all sorts of good stuff. Pepperstone, of course, thank you guys for allowing me to talk about things that I think are going to help you with your trading. They're pretty good in allowing us to kind of share stuff that others don't talk about, because others was regurgitating the same old stuff, and I think we can be better than that. So let's have a look at the questions, guys. Let's see what we've got. And by the way, next month I've got a really good one for you. I know it's August, things are slowing down, but it's actually perfect for August. Other questions are coming in. Actually, Nasdaq's not too. It's the Dow that's taking a little bit of a battering, isn't it? How's Euro doing? Not a lot. Not a lot. Has climbed back to the VWAP. I wonder if that 15-minute break trade would have. You would have just about got away with that. That's so close one. Anyway, right. Questions. Bob says, does this fit into each box, like daily for terrain, 15 or 5 for rhythm, etc.? How would you describe it? I ask time frame questions every week because I learn these things. I want to plug into the right place, because if I plug and play these strategies, you do, Bob, and I appreciate you coming on, as I appreciate all you guys coming on and asking these questions and making it fun for us. Bob, the thing is with time frames is, I think I said this before, don't get too caught up in the actual number you're pumping into that chart, right? You just want to calibrate to the condition you're in, right? So, if you get too forced into a box, like it's the 15, it's the 5, then you end up, and there's nothing wrong. I'm not saying don't do this, because sometimes you want to just kind of make sure you calibrate and look at the 5, look at the 5, look at the 5. But your job for terrain is to say, well, what are we doing, right? And at the moment you go, well, actually the 15 is not very useful for me. I'm more interested in the daily on the 1 minute, because that's giving more of an insight to the type of trader that I am, right? And so, you look at the terrain questions you want to ask yourself is, what's the higher time frame? That's going to be a daily. If you want to ask a middle time frame question, then you go, okay, what's the 50-minute, 60-minute? That's not, at the moment, that's not going to give you much more, especially if you brought up something like the Nasdaq on a 15-minute. Not that much more information the daily is giving you or the 1 minute's giving you. You're not getting more there. But if you go down to the 5, you go, actually, we've sold off heavy off the open and we've held below the lows. Okay, so is that a different structure? Is that a different thing? A different terrain we're in? Yeah, very slightly different from yesterday, even though the higher time frames are the same. Actually, because we sold off from there, maybe there is some sellers about. Maybe we're more interested in waiting to see what the Fed does tomorrow. Bob followed up with, like in multiple time frames, which one is tactical time frame? Which is the rhythm time frame, especially? That's the answer for you to find, Bob. And like I say, I don't repeat myself too much here, but you can get all the information you need from a daily chart. Honestly, I know some people say, well, I have to have the 15 and 60. That's fine. If it's working for you, great. But I think you can overcomplicate it by having too much stuff. You basically want to see what's happening on the higher time frame and what's happening on the lower time frame. And what's the lower time frame for you? Is it 3 or 5 or 1? It's the same type of thing, really. You just have to execute on that because that's important for you. And it's overthinking about, well, the 15 says this, but the daily says that. It's like, well, we're in an uptrend. We're in an uptrend at all-time highs. That's fact. Bonk. Right, now, what's important to me? If you're executing on a 1 minute, the 1 minute's more important. If you're executing on a 5, the 5 minutes more important. And then what's the terrain on that for you? Like, hey, the 1 minute, like if you just looked at the 1 minute now, you might be like, hey, we're actually on a higher time frame. We're at all-time highs. But on a 1 minute chart, the Nasdaq is like pushing back to those lows. That might be the trade for you. It's like, okay, well, I know I'm counter trend, but the most important thing is a 1 minute. If you're trading off the 5, you might be like, oh, hang on a second, I think we might just test that low and bounce back off it. So it's building the kind of time frame, or stacking the time frames up to suit you and your outcome, as opposed to the other way around, which is my outcome and then my time frames. But summary, go to the daily. You can get so much. Think about how valuable the daily is. I don't want to bang this drum too much. The daily, everybody cares about the higher the day, the lower the day, the open, the close. Everyone knows that everyone cares about it. Not everyone cares about 15 minutes. Some people couldn't give a damn about the 15-minute chart or the 60-minute chart. It's only giving you structure and rhythm for your trading. So the daily is always a good first port of call, mate, because everyone's looking at it. Everyone's making decisions on that. The higher time frame players, the kind of investment banks and stuff, they're not looking at lower time frames unless they've got obviously strategies on that. But it's the higher time frame that's the most important. And then you plug in one more, which is going to influence your decision making. Gary says, good point regarding targets and conviction. Thank you, Gary. And I honestly, mate, I think that is so key. It's an unlock to be able to go. And you know what it's like, right? You're in a trade. Oh, it's going to come back. It's going to do this. It's going to do that. When you have that target, you go, no, I still think that's going to be hit. And actually, I've got more chance now because the trade's gone my way. So why am I deciding to close the trade? It's just foolish. And so I think that really does help you build that conviction. Bob also says, I've been getting 7-to-1s regularly, targeting hourly levels in 1 minute entry, sometimes a hold for the whole trend on the hourly once I've entered around the low. Good, Bob. You do more of that. If that kind of hourly 1 minute cadence is perfect for you, keep doing more of it. Bin off 15, bin off 5, bin off my talk of the daily. Find out if that's working for you. Then good. Junaid says, great webinar. I need to slow things down. Great webinar, Mark. Thank you. Hope this weekly clinic continues for the rest of the year. I hope it does too, Junaid. If you want to message Pepperstone and tell them how appreciative you are for these, then that'll help us keep going. Thanks, Mark. Barry. Thanks, Mark. Thank you, Barry. I'm terrible at recognizing the terrain, such as the DAX you mentioned. It was obvious it was a trend day after the event, not so easy at 8:30. I know there was tariff news, but recently holds haven't been working. Anyway, and ideas to help gauge the terrain beforehand, or is it just look for major levels, news and the like? You know what, Barry? Anyone who tells you that they could see what was happening yesterday before it happened, I don't buy it. Like you, and I think you're absolutely correct here, mate, the market has been buoyant. So to dive in short straight away, I don't think would have been the right trade. I think that would have killed you over this past couple of months. So you're exactly right. Now, the question you have is, does the terrain shift? And actually, if we go back to that DAX, let's go back to it. If I can find it. Whereas that's Euro, that's this, that's Euro again. There we go. Right, so we go back to the DAX. It's only after a period of time you go, hang on a second, things have shifted. Like we've sold off from the open, and I kind of put a line here from the cash open, and I've anchored the VWAP there as well. We haven't reclaimed the VWAP, and we keep kind of grinding up. The movements we have up are so shallow compared to the movements we have lower. And so even if later in the day, like 12 o'clock, 1 o'clock, you're like, hang on a second, we've not bounced much. We've not reclaimed the VWAP. This is unusual. Euro is getting sold off. Now at that point, Barry, you go, hey, things have shifted, right? I agree with you. 8:30 in the morning, no one knows, a clue what's going on. You might be like, hang on a second, we could sell off today because we have the news. We could. And so you're primed and you're ready, but you don't know for sure until after the event. The key is having the sweet spot in the middle where you go, yeah, now I'm going to look for shorts because I believe it's a complete risk off day. I've got lots of evidence to suggest it, and fine, you're not in from the opening print, but there's still lots of meat on the bone left for you to trade it because the terrain has become more clear to you. And that's difficult for many traders because I think the move's gone. And fine, you might be like, hey, I'm only trading long at the moment because we're in an uptrend. And that's fine. You could do that. But there's a time when you go, hey, and what one thing you can do, can help you, Barry, is replay this. So go to TradingView, do your replay, and kind of look where things change. And you go, hang on a second, things have changed. The bounces off lows aren't very strong. They don't go very far. We don't claim that the VWAP. where do things really kind of change? And I think, just looking at this chart here, because I wasn't trading the DAX at all, 12.15, hopefully you guys can see that. I don't know if it's big enough, but 12.15, things change because we go to a fresh low. The creep back up is so poor, and then it really starts to roll, gather momentum. So it's not always about getting it right first time. It's about, assessing the conditions and saying, hang on a second, we are bullish, but actually today the terrain's very different. And don't also, Barry, and that stands for anybody, is don't beat yourself up if you look at it and go, I don't know what the terrain is. Leave the car in the garage. Like, I don't know what the terrain is. That's fine. Maybe you can say, well, I'll check again and see if it becomes clearer. I'll recalibrate and I'll have a little other look in an hour or two, or after so-and-so close, or after this. I think that can really help you not try to overthink stuff, because it should just be like, oh, yeah, man, this is a real kind of downtrend here. I want to get short. I hope that helps, pal. Okay, good name. Tolu Wanami. I think I've nailed that. Can we get slides? Can we get recordings? You can get the recordings. Certainly, they will be sent to you. As a scalper or day trader, what entry triggers do you see that work over time in your years of experience? Entry triggers, I like engulfing things. I like flushes that kind of drag out the last people at the end of a trend. They're really good. We haven't had many of those recently. We had those quite a lot in the tariff type of stuff. I like momentum ignition, especially off a low print. So if I'm buying, looking for a buy, kind of grinds low, and that's actually working a lot more at the moment with all the caveats of do your own research, blah, blah, blah. But if you go back and replay lots of NASDAQ type stuff, we get drop moves to lows. We often get a momentum ignition bar off that low that can then be followed and the stop put below. So stuff like that, I think, is pretty decent. Okay, that was a good question. Matthias, I butchered it, mate. Sorry. How to best know when the market cycle is switching? You know what? I'd love to say there's a perfect signal or system or indicator, but it just comes with experience, and you never know, right? But you kind of look at the clues and you say, is it worth this? Do I think it's this? Do I think it's that? And you kind of look at the clues of like, okay, well, how much do we stay below the VWAP if you're an intraday trader? How much business do we do below the prior low? What's our response to the open? What's our response to news? That's a pretty key one as well. That's a Jason Shapiro special. It's like, okay, we have good news and we're selling off. Well, maybe the conditions are switching. Maybe people are kind of thinking about things differently. Justin says, thanks, Mark. As always, amazing content. Appreciate you, pal. Thank you, Justin. Always appreciate the feedback and criticisms. Even though it wasn't a criticism, it was a bit of positive feedback, but I accept it both. John Windsor Daily, how you doing, pal? Thanks again, Mark. Great. Oh, he didn't say that at all. He said, thanks again, as always, Mark. This is great stuff. Simply put and so powerful. Cheers, John. Good. I'm glad, that really does, bring a smile to my face, John, because trading it's simple, but it's so hard. And I think the simple concepts help when we've got so much cognitive load in the day, got so much going on about risk and this and that and discipline. You can just come back to this kind of North Star of, hey, man, I just got me my triple T's, whatever you call it for yourself. Do I have this? Do I have this? Do I have this? No. Okay, well, back off. Wait. And just that kind of process, really helps stuff. Hello, Dominic. Hello. I want to know precise entry on the GBP currently. If you check on daily time frame, there is head and shoulder formation. What you look at on your entry. Sorry, Dominic. Nope. I'm not here to give you trade ideas or recommendations, pal. I'm not really a cable trader, so I wouldn't be doing you a justice anyway. Everyone else knows this, I think, but we're here to kind of build your own model, your own conviction. You won't have conviction. If I look at cable now and I say, yeah, I think it's a screaming buy or a screaming sell, you take the trade, it goes a little bit in your favor and starts to come back, you'll close it. Whereas I might be have so much conviction, we're going to take this level out. You need to build your own, and I'm not here to kind of beat on you, pal, but you build your own process, your own conviction, your own formula, so that you are able to sit through and weather the storm when things aren't going your way. Okay, last few questions. Andy says, when there are multiple news coming out in a day, how do I know which one will drive the market? You let the market talk to you. You look at your red book news, so you kind of filter out for high impact news, which is very easy to do on the economic calendar, so you know that that's likely to move the market. And then you watch the price response. Price will tell you. I know this sounds such a simple, almost patronizing answer. I genuinely don't mean it to be, but that's trading in a nutshell, is how does price respond to the news, good or bad, and because you don't know for sure, right? You've got an idea NFP is going to move the market, FOMC is going to move the market, Jay Powell speaking is going to move the market, but you don't know how much, you don't know which direction, and so that comes into the terrain of like, hang on a second, good news market goes up, good news market goes down, terrain shifted a little bit. Okay, two more questions. Thanks. Theo says, thanks so much for this webinar, Mark. Appreciate you, Theo, as always, pal. My current system has similarities to this TTT. I'm working on a quadrant of factors. Good, I like it. Daily trend, 4-hour structure, 1-hour momentum, and then a 1-minute pattern. It's proving effective. More importantly, it's taking the stress out of much of my trading. Good, Theo, you're finding your rhythm. I like it, pal. I like it a lot. Tom says, thanks, Mark. Always super helpful. Appreciate you, Tom. Justin says, hi, Mark. Do you anchor your VWAP at the open of the session or the open of a specific market? Open of the session, Justin. I want to see when that session starts, how price is performing to that. That's my most important reference point. I will anchor, is a separate kind of going off piece slightly, but I will anchor my VWAP at a key data point. So if we have the tariff news and we have positive news, or negative news, I'll anchor the VWAP after the open there to see how all the buyers, the average kind of price that we've got based on those buyers. Richard Harris says, first time listener, welcome, Richard. Thank you for joining us. Hopefully you'll be here for many weeks to come. Great session and really informative. I do appreciate your feedback, pal. And Justin says, brilliant. Thanks. Well, thank you, guys. As always, I do appreciate your feedback, comments, and hopefully we'll keep doing these and keep moving that ball forward, keep pushing the momentum, just get a little bit better in your trading, session after session, 1% better a day, adds up, man. It's not a linear progress. Sometimes it feels like you're banging your head against a brick wall, but simplifying things down, having a process, managing risk, and just carving out your own rhythm and your own flow and your own approach to the market is worth its weight in gold. All right, guys, thank you so much. See you next time. Appreciate you all. Take care. Bye-bye.